All right, guys, thanks for joining us today. We've got a special guest who's flown out from the United States just to see us. Well, he's seeing other people as well, but he came specifically for us to inform us of what's going on in the global economy, and that's Jim Rickards. Welcome, Jim.
Great to be with you, Philip.
Fantastic. Now, Jim, you've got a new book that's come out recently.
Right.
Now, they say don't judge a book by its cover, but I look at it and it's, I've got to be honest, it's a little bit scary. It's got a meteorite hitting a pile of cash, and it's called Aftermath. Now, Aftermath suggests that something bad's happened and we're living in the post-reality of that. What's the book about? Is it about meteorites or something else?
Well, the meteorites are a clue. It's Aftermath is volume 4 of a 4-volume international monetary quartet. So the first book was Currency Wars, came out in 2011. Then The Death of Money came out in 2014. Then The Road to Ruin came out in 2016. You can see I have these nice cheery titles. And then Aftermath comes out in 2019. The Aftermath title has kind of a double entendre. Yes, it's the aftermath of the 2008 global financial crisis. We're still living through it. The issues are not resolved. We'll have more crises sooner than later because it was sort of handed off to the central banks, but the central banks have not been able to get their balance sheets back to normal. They've not been able to get interest rates back to normal. So they're completely unprepared for the next crisis. And then looking forward to the next crisis, what will the aftermath of that crisis be? And my suggestion is, with a lot of evidence, I think, to support it, is that will be a different world. And a lot of people, when you're in my position, you're an author, speaker, you're, out giving, doing consultations or presentations or whatever. People want to put words in your mouth. They say, well, Jim Rickards says this or Jim Rickards says that, most of which I never said. People say, well, he predicts the end of the world, sell everything and buy gold. I've never said that. I don't think it's the end of the world. You should have some gold, but not too much. But that doesn't mean we won't have a severe financial crisis that will change not just the economy, but the way people live and the way they interact. And so I'm talking about the aftermath of the last crisis and the aftermath of the next crisis, and kind of explaining why there will be a crisis, why there are cracks in the foundation. And that's really what the book's about. The specific issues, policy issues, facts, developments that will lead to a new crisis.
And with this new crisis that you see coming, what do you think are going to be the triggers, or is it all in motion? Like, is there anything that can be done? What do you see there?
Well, there's a lot that can be done, but nothing that anyone wants to do. In fact, you could have gone back even further and avoided the 2008 crisis. This is the next one will be really the third in a sequence. The first one is 1998. That was started in 1997 with the Asian financial crisis. Sort of calmed down in the winter, spread around the world, blew up with Russia in the summer of 1998, and then came home to roost at Long-Term Capital Management. That was the hedge fund in the United States that it nearly failed. But if it had failed completely, it would have taken Wall Street down with it. Lehman Brothers would have failed in 1998. Forget 2008. Would have happened 10 years sooner. But instead, the major investment banks, the 14 largest investment banks, got together. They pulled $4 billion of cash, put it into long-term capital, in effect propped up the balance sheet. They became the owners of the positions, of course, and then took about a year or slightly more to unwind it gradually, as opposed to doing that in the panic. But the world came within hours of completely shutting down. I was the counsel of long-term capital management, and I negotiated the bailout. I was in the room, had a front row seat on the phone with whether it was Treasury officials or the CEOs of the major banks and so forth. And we did get it done and brought it in for a soft landing in that sense. But it was a close run thing, as they say. And if it had not got done, the Tokyo Stock Exchange wouldn't have opened that day. And one by one, exchanges around the world sequentially would have shut down, at least for a while, and it would have been a lot worse than what happened in 2008. Well, obviously in a situation like that, there are lessons that could be learned. One is don't use excessive leverage. When I say don't, I'm not just talking about long-term capital. Long-term capital was an example of what I'm talking about, but it can apply to the system as a whole. Don't use too much leverage. Don't use derivatives. Too much opacity. Not enough information. Bad risk management models. Value at risk. A lot of the hypotheses behind modern financial theory are demonstrably false. It's not just an opinion. You can show it empirically that they're false. And you should have learned all those things. And one of the results would be don't repeal Glass-Steagall. Don't allow any more mega bank mergers. Maybe break up the biggest banks at the time, banned almost all derivatives. The exchange-traded derivatives that have a commercial use tend to be a lot safer. Perhaps those could continue, but most of the derivatives market is just a way for banks to steal money from customers and serve no purpose other than kind of gambling.
Yeah. Well, didn't they recently just change? The Paul Volcker rule to allow?
They are. It's kind of like getting ahead. In 2008, this happened again. They did pass some legislation, but even that's being watered down. So Wall Street, through its ownership of Washington, seems to be completely incapable of dealing with the causes of this crisis. So in 1998, in effect, Wall Street got together and bailed out a hedge fund. Come forward 10 years. In the following years, what happened? They repealed Glass-Steagall, which was our legislation separating commercial banking from investment banking. For about 65 years, it had been the case that you could take deposits and make loans, or you could underwrite and sell securities, but you couldn't do both. Well, once they repealed it, you were allowed to do both. This turned our biggest banks into hedge funds, in effect. They also repealed some legislation that allowed derivatives on just about everything. Prior to that, you could only have derivatives on certain instruments. After that, after 1999, this was, you could have derivatives on anything. Of course, that led straight to Enron and a few other fiascos. But by 2008, 10 years on, it was kind of a replay of what had happened in the 1920s. So now we were set up for an even bigger crisis. This time, it wasn't a question of Wall Street bailing out a hedge fund. It was a question of the central banks bailing out Wall Street. In 2008, everything would have collapsed. Bear Stearns did collapse. Lehman Brothers did collapse. Our two biggest mortgage agencies, Fannie Mae and Freddie Mac, collapsed. And Morgan Stanley was days away in mid-September. Then Goldman, Citi, all the rest would have fallen too. But through central bank intervention, what did they do? They guaranteed every bank deposit in America. There was no requirement to do so, but they did. They guaranteed every money market fund in America. Again, no requirement to do so, but they did. $10 trillion of currency swaps with the European Central Bank, because the European banks needed dollars, couldn't get them because the ECB prints euros, not dollars. So they did a swap, massive swap with the Fed, and the ECB got the dollars and then parceled them out to their banks. And that prevented the sequential collapse, the cascade of bank failures, but it also truncated the cleanup, if you will, bad assets and bad banking. It would have been much better to allow most of those banks to fail. I would say the government could have come in, nationalized them, stripped out the bad assets, put it in trust for the American people, and then given the bondholders a haircut, wiped out equity, have recapitalized banks, and then just IPO them as clean banks. And the losses would have been massive, but they would have fallen where they deserved to fall, on the stockholders. But that wasn't done. Instead, we ripped off American savers for about $4 trillion through zero interest rates to prop up Jamie Dimon's bonus. Here we are 10 years on. So the point is, are there things you can do? Yes. Are they being done? No. Are they going to be done? No. So what does that mean? Well, we're just, probably not a very long period of time away from the next crisis, with one difference, which is now that the debt is at the central bank level. Again, 1998 took it from hedge fund to the banks. 2008 took it from the banks to the central banks. Who's going to bail out the central banks? And that's really the problem. Your only alternatives are turn to the IMF to basically bail out the world, although that's a slow and difficult and kind of fraught process, or shut the banks. And that's what I expect. They'll close exchanges, close banks, close ATMs, freeze accounts. They'll say, we're not taking your money, but we're just going to have a bank holiday, an extended bank holiday, if you will.
It's not a fun holiday either, is it?
No, it's not. And I say things like that, and people say, oh, that would never happen. I say, well, talk to people in Cyprus, Greece, Argentina. It's happened many times. In 1933, every bank in the United States was closed by executive order of President Roosevelt. He just said the banks were closed. When he gave that order, he didn't say when they would reopen. People just had to sort of bear with it. Now it turns out they did reopen about 8 days later, but no one knew that at the time. It could have been 8 days, could have been a month or 2 months. In 1914, the outbreak of World War I, the New York Stock Exchange was closed for 5 months, from July 1914 to December 1914. So every one of these things has happened before. Some of them have happened very recently. They happen because there's nothing else you can do when you don't have a source of liquidity. I mean, if you say, well, why can't we just turn to the Fed again? Well, the Fed took their balance sheet in 2008, beginning 2008, They took their balance sheet from $800 billion to over $4.2 trillion. They've only come back a little bit. They're still in the high threes, 3.8, 3.9 trillion. What are they going to do if a crisis hit tomorrow? Go to 5 trillion, 6 trillion? At what point do you pass an invisible confidence limit where you've destroyed confidence in the dollar itself?
Well, that's my question is, like, how far can they kick this down the road? Like, obviously they've moved rates up since Trump's presidency, 7 or 8 times. But around the world, it seems this time it's going to be like a global crisis. And I mean, yeah, like what can the average person do? And I mean, how long can they kick this down the road, given if they did start implementing a few measures to do that?
Well, no one knows, and that's part of the problem. I mean, people, the two questions I'm asked most frequently, because I'll describe the systems analysis and the complexity and how things actually work and why they're leading to a new crisis, and people will listen and say, well, that's all very convincing. I understand you. Could you call me 3 o'clock the day before and let me know, and I'll sell my stocks and buy gold? And I'll say, well, 2 things. Number one, I'm not going to know what day it is. I can tell you it's coming. I can explain how and why. I can estimate the order of magnitude of the crisis, but I won't know the exact day, or even if I did, I'd probably be a little busy that day. But what I say to people is, what are you waiting for? Because when the crisis hits, it'll be too late to protect your wealth. You'll want gold, you won't be able to buy it. If you don't already have a dealer, well, even if you do have a dealer, they'll probably be backordered. If you don't have a dealer, they won't return your call. The dealers themselves won't have gold because the mints and the producers will be backordered. You won't be able to get gold at any price. It won't be a question of price, or can I pay more? It simply won't be available. Today it's available, and the prices are going to go a lot higher, and so it's a good opportunity to kind of get your gold reserve, put it in a safe place, and then sleep well at night. And when the crisis hits, you won't have to worry. You'll have it already. But you won't be able to take the precautionary steps in the crisis. It'll be too late.
Yeah, and I guess that's the question everyone's going to want to know, is how they can make money from it. And obviously, you're predicting the gold price to move north, which it has been recently. Like, it seems to have broken out of its trading pattern, and for the last 12 months, it's been doing very well. And like, would you recommend people get? Obviously, this is not financial advice, and every person's situation is individual. But would you recommend they get physical, get in gold stocks, or how could they potentially benefit from this coming collapse?
Well, the thing with gold stocks is they have kind of embedded leverage because of the way stocks are valued. So gold stocks are a good way to make money from a rising price of gold. You actually should make more than if gold is up 20%, let's say. Gold stocks could go up maybe 40 or 50% or 100%. They could go up a lot more because they have fixed costs and variable costs, and the fixed costs don't increase as the gold output increases and as the gold price increases, and so the margins go up and people apply a multiple, and that's one reason you can make a lot more in gold stocks. Having said that, you have to be very, very careful about the selection. I like to say that all gold miners have certain things in common. Geology is what it is, the feasibility study is what it is, gold quality is what it is, capital costs are what they are. All those things are the same for everyone. What's different is management. Some gold companies have great management. They know exactly what they're doing. They have a track record. They control costs. Other gold companies, some of them are frauds. Some of them may not be frauds, but they have really poor management. So obviously you don't want to be involved in those. So you do need some source of advice, and it can be research reports from brokers and banks. It can be newsletters written by very knowledgeable editors.
Small caps, of course.
Yeah, I'm sure there are sources out there. But the point being, you can make a lot of money in gold mines, but you have to be very careful in the selection.
Yeah.
Having said that, I would make the bulk of my allocation into physical bullion. The problem with this, gold futures, gold options, gold ETFs, I mean, mining companies are real. You own the stock, you own the stock, but all the other gold derivatives, you don't own gold. You have a contract, and you have to read the contract. Or if it's exchange traded, you have to read the rule book. You have to be a geek like me and actually read the rule book. Every exchange rule book I've ever read, and I've read many, has a rule that says we can change the rules. And you have people like the Hunt brothers in 1980 and the silver crisis. They were whining that the NYMEX exchange changed the rules. Well, read the book. They have a rule that says they can change the rules. What they'll do, and people say, well, What if all the people who are long gold futures on the COMEX woke up one day and decided to take physical delivery instead of rolling over the contract or canceling it out? They just took physical delivery. There's not enough gold in the warehouse to meet those demands. Well, of course there isn't. There isn't anywhere near enough gold. And the exchange knows that, but they say, we're not a source of supply. And if everyone, we're just here for price discovery and hedging and all that, and if everyone did demand their gold, what they would do is close the exchange. This is what I was talking about earlier. They would close the exchange. They would send everyone a termination notice. They wouldn't steal your money. They would give you a check for your profits as of the close of business yesterday. But you'd be, wait a second, I want today's profits. I want tomorrow's profits. This is why I bought this gold for you. Too bad. You would be closed out. You would get the check, but you would miss the super spike, where it goes hyperbolic. You would miss that because they would have terminated your agreement. Same thing with London Bullion Market Association gold forwards. You call up JP Morgan, say I want to buy a ton of gold. I mean, good luck with that. It'll take them a week to find it, but or a month maybe. But they say the gold on an unallocated basis, and unallocated is a euphemism for no gold. In other words, they might have a ton of gold sitting there, but they'll sell the same gold to 100 people, and it doesn't belong to any of them, but it's there in case one person demands it. They can deliver and get another ton to replace it. What if 50 people demand the same? What if 50 people have 1 ton, and there's only 1 ton of gold, and they all demand it at once? Well, again, the same problem. They don't have 50 tons to deliver. They have 1 ton to deliver to the first customer. The other 49 are going to get a termination notice, either under a force majeure clause or material adverse change clause, or just any early termination clause against all in the contract. And so they're not going to get their gold either. So gold futures, gold options, gold, unallocated gold contracts, LBMA standard contracts, ETFs, same thing. None of them are gold. They're paper claims that can be terminated, and you won't have the gold when you want it. Physical gold is good. And gold miners are different. I mean, there's real gold there. It doesn't belong to you. It belongs to the miner, but you own stock in the company.
Yeah. So it seems like having physical gold is the safer bet to go with.
Sure.
And with that, like, you've been making some predictions on the gold price, and is it $10,000 we've got on Britain?
Well, that's an intermediate range price, and you say that, and people look at you like you're crazy, which I'm not, or you're trying to get publicity, which I don't care about. So I don't put the number out there to attract attention. It's the number that comes from actually fairly rigorous analysis, and you can do 2 or 3 separate analyses and get to the same number or approximate. So let me just give you a couple examples. One is, what if you did have the kind of monetary crisis we're talking about, like global liquidity crisis, except one that this time was too big for the Fed to bail out the world? And maybe the IMF would do something, maybe they wouldn't, but even if they did, it could take 6 months to a year. So you have this kind of period where you're freezing accounts and so forth. One of the things that could happen is, goes by different names, a reset, reboot, reform of the international monetary system. But you could have something like a new Bretton Woods conference where, a convening power gets the G7 or the G20 or, the leading top 10 gold holders in the world together to reform the international monetary system. If you wanted anything from a strict gold standard, a classic gold standard of the kind we had in the late 19th century, or even a modified gold standard where gold was going to be a reference point for discretionary monetary policy, as a way to restore confidence, saying to people, okay, we get it, you've lost confidence in us, but don't worry, we're going to use gold as our benchmark, and you can be assured that we're going to maintain price stability, and you'll be able to cash in for gold at a certain price, some system like that. Well, you can do that. We've done it before, and you could certainly devise something like that to restore confidence, and you may have to. No central bank in the world wants a gold standard.
But do you think, I've been hearing, obviously China and Russia are buying a lot of gold, and I think Iran recently introduced a gold crypto or something like that. So it seems to be some countries are maybe headed in that direction. Is that something that they're gearing up for?
Well, yes, and that's a separate issue. We can talk about that in a minute, because now you're into geopolitics and financial warfare and all that. But just to kind of finish on the gold price, so it's critical if you have any kind of new gold standard that you get the price right. It's one of the criticisms of a gold standard. You hear it over and over, and I talk about this in my book, The New Case for Gold. People say, well, gold's interesting. It used to be the monetary standard, but there's not enough gold in the world to support commerce and credit and extended balance sheets and payments, and there's just not enough gold in the world to do that. And that's nonsense. There's always enough gold. It's just a question of price. Now, at $1,500 an ounce US, which is approximately where it is today, no, there's not enough gold, because the gold you have at $1,500 would only, you would have to drastically reduce the money supply by over 50% to maintain that parity of gold to money, and that would cause the greatest depression since the Great Depression. It would be highly deflationary. But you could take the same amount of gold and reprice it at $10,000 an ounce, and now suddenly the same gold would support a much larger money supply. So it's never a question of how much gold you have. It's a question of what's the price. And if you took, so China, US, Japan, and Europe, they're the big four. I mean, there are other important, Canada, Australia, UK are all important, but those four countries are over 80% of global GDP. Their M1 money supply is about $24 trillion. So what if you said, okay, we want 40% gold backing? And historically, that's a pretty high number. Some people would say it has to be 100%. Other people would be comfortable with less. But let's just say 40%. Well, 40% of 24 trillion is $9.6 trillion. There are 33,000 tons of official gold in the world. That's not counting private gold, which is a larger number, but that's owned by central banks. Well, if you take 33,000 tons divided by $9.6 trillion, which is how much you have to back, it comes out to about $10,000 an ounce. So when I say that number, it's not pulled out of thin air. It's actually the implied non-deflationary price of gold to have any kind of gold standard. By the way, we've had two great bull markets in gold. 1971 to 1980, gold went up over 2,000%, from $35 an ounce to $800 an ounce. From 1999 to 2011, gold went up 700%, from about $250 an ounce to $1,900 an ounce. So the new bull market, the one we're in now, started on December 16, 2015. You can actually date it. That was the low, $1,050 an ounce. It's up about 50% from there. So the first bull market was up 2,000%. The second one was up 700%. The new one's up 50%. It has very far to run. This will go on for years. But if you just took the average of 2,700 and applied that to the new bull market, guess what? You'd get to $14,000 an ounce. So my only point is these are very simple calculations. They're historically rooted. They're not made up. But numbers like $10,000, $15,000 an ounce are not pie in the sky.
I agree. And also, like, if there's a currency collapse, the currency becomes worthless, so you could almost put any number on it.
Exactly. But that's a very good point. But in that world, people won't be discussing the price of gold. There won't be a price. It'll just be, can you get it? And what do you pay for it? Because they won't take dollars. Absolutely. And if this collapse does occur, let's fast forward a little bit. Let's just say it's happened. What do things look like? Because it seems like this next crisis, or not even just crisis, like you look at things like automation and robotics and AI and things, it seems like a lot of people are going to lose their jobs, and it's not just the low level anymore. They just done studies, and they can beat lawyers, these AI machines. So you got high level people, jobs and whatnot that are potentially going to all get wiped out. Well, not all wiped out, but they're going to get replaced. So I mean, what does the future look like in this sort of, how does the economy work? What do you foresee? Well, that's a very good question. And again, people, artists, filmmakers, and novelists, and others have created World's Cormac McCarthy's novel On the Road, The Road, the Mad Max films. That's a very dystopian future, complete chaos. That's not what I foresee, and I've never predicted that kind of end of the world scenario. But what I do foresee is a world where it starts out with enormous social unrest. People don't realize that the veneer of civilization is paper thin. And we saw this in 2015, August 2015, August 2005, with Hurricane Katrina in the United States, where the city of New Orleans was cut off. And order broke down within days. So the first day, everyone's in shock. You're just recovering. Did we survive? How do I get some food? By the second day, People are becoming desperate for food and water. By the third day, violence is broken out. You have vigilantes, you have looters, National Guard moving in. So civilized behavior, let's say, only lasts about 3 days in the absence of reliable food, water, electricity, and all the things we take for granted. And so you could have, in a true financial panic where you had to shut down the banks and people can't get money out of ATMs, as I said, they're going to start looting stores, and that kind of social disorder breaks out very quickly. To restore order, you could go to martial law, which they will, and the governments will do that. But you end up with a lot of systems breaking down. This is how complex civilizations collapse. It's not usually barbarian invasions. They usually collapse internally because of too much bureaucracy, too much taxation, too much complexity. They kind of fall their own way. And I have a chapter in my new book, Aftermath, describing the physical properties and equations behind that. This is not just sort of a generalized theory of sociology. It actually is. There's very good science to explain how complex dynamic systems, including a civilization, collapse. So we could end up with a more communitarian world where we have to, I know we have an expression in the U.S., I don't know if it's widely used in Australia or elsewhere, called preppers. I mean, you're prepared for this catastrophe, but your typical prepper is someone that got a cave and machine gun or semi-automatic weapons and canned goods and water, and they're ready to defend their stash of food against all comers. That's not how I think about it. I don't think that's a very effective strategy, by the way. But I think how people can survive is by living in a community where you actually know your neighbors. You may have a semi-barter system. Maybe a guy's a pretty good dentist and somebody else is a pretty good landscaper, and he says, hey, I'll mow your lawn if you fix my kid's teeth or something. It's not really a money-based system, but you're not going all over the world, and you're not dealing. The areas that will feel the social disorder the most acutely are major metropolitan areas. The areas with the best resilience and the ability to survive will be outlying areas, farm communities, any community where two things are true. Number one, neighbors trust neighbors, and two, there are diverse skills, artisanal skills that you can kind of trade, and somebody will have a farm and they'll raise food. But one medium that will work very well in that environment is our silver coins. And I like gold as an investment, as a way to preserve wealth, but gold's almost too expensive if you're trying to buy food for your family, whereas a 1 ounce silver, 2 ounces of silver might be a week's worth of groceries. So it might be a world where you get on your bicycle, go down to a local farm, take out a couple of silver coins, buy some cheese and dairy and pork bellies or whatever, and go back home and cook it up. That works. I mean, that's the way the world was until really almost the 1910s, and so we may just go back to that.
Yeah, that'd be interesting. I'm glad that's the way you answered it, because I do think we're almost having that bit of social unrest coming now. Like we've got Hong Kong.
Yeah.
It's not been reported in the Western media, but France for like 40 weeks straight, they've had their rallies and riots over there. It's popping up everywhere, and I do feel
Venezuela is another example. Venezuela is an extreme case, but good reason to think that Venezuela is a precursor of what's coming elsewhere.
Yeah, and I do feel like this old system is going to fall, like you're saying, it's going to change, fall apart, whatever term you want to use. There will be that period of social unrest, but then after, hopefully something better can come from it. And I think, even something like a 5-day work week might have to change to heaven forbid, a 4 or 3-day work week, and people can focus on other things and maybe pursue their passions and stuff. So I think there is a positive end to kind of what's coming, even though, what's coming ahead might be scary, because obviously it's an old system that's reaching its end, I guess.
I think PhD economists might be the most vulnerable because they have the least to offer. But hopefully they can move in with a sister or brother who has some more valuable skills. By the way, there's a book, I write about this, but we're describing obviously in the conclusion of my book, Aftermath, but there's a book that I refer to that I view as it's a novel. It's not an economics book, but an excellent description of what life is like in the situation. So the world still exists, it hasn't burned to the ground. But the book's by an award-winning author named Lionel Shriver, and her book is called The Mandibles. But it's about 4 generations of one family living in the aftermath of a global financial crisis. So she doesn't spend a lot of time on the crisis. It's happened, but what is life like? And without giving away too much, because it's a novelistic elements and a surprise ending, so I don't want to say too much. But there's sort of one sister in the third generation of this 4-generation family, and she's got like a kind of an ordinary job, like a teacher, and she has an apartment in Brooklyn, and she has one sister who's married to a university professor, and so on. But one by one, they all lose their jobs and they move in with her. So you got sort of 4 generations of this family living in one flat. But she's the only one who can kind of pay the rent and get by. The police are around, but they don't protect you unless you pay them. And you can go to a supermarket, but the shelves are pretty bare. And you might buy a packet of bolts, not because you need bolts, but because somebody else might need them and they're available. So you buy them and hoard them, and at some point you can trade them for some food. So life goes on, but it's a very, very different life with a lot more struggle. And this is in a city, and then there is a sense that maybe we need to move to the farm.
Interesting, yeah, and I think a lot of people are starting to move to that self-sustainable, like that's a big movement that's growing at the moment. Yeah. And I think more and more people are realising that maybe we don't need these. I don't know what your opinions are on politics, but I've always thought, like, why do we even need these politicians? Like, everyone complains that they're corrupt or whatever, but we still vote for them. And I feel like this new system with technology and things like that, maybe we can move to something better and, that lets people live their lives the way they want. Because at the end of the day, like, no one's really in control of the planet. Like, we're flying through outer space, no one can protect us, so we should just kind of maybe work out a better way of living and doing that. Hopefully, that comes from the...
Yeah, people are very, very, not very good, and it's the people, including the government, are not very good at disaster planning, because you have to think through, like, to the 4th and 5th derivative of whatever you're preparing for. I've done some work like this for the military, and they'll say, well, in the United States, our Department of Defense, they'll say, well, here's our plan to evacuate Washington. And I look at them and I say, look, you can't get out of Washington on a good day. The traffic is so bad, you can't get out of the town on a weekend. You think you're going to evacuate this town in a crisis mode? I'm like, yeah, you're right, but we have to have something. I said, well, if you want an evacuation plan, include motorcycles and bicycles, because they can actually move. And, I live in New Hampshire, but I lived for many years in Connecticut, very close to Greenwich, Connecticut, which is sort of ground zero for hedge funds. So, through friends and acquaintances and jobs and so forth, you meet a certain number of kind of hedge fund billionaires. And what's interesting about them is there are 2 things. One, they may trade stocks, bonds, or derivatives, or commodities, or whatever, but they all have gold. They don't talk about it. They don't showcase it, but they all have a lot of gold bullion in their personal portfolios because of the kind of scenarios we're talking about. But then you say, oh, where is this? Oh, it's really safe. It's in Zurich, Switzerland, or it's in Singapore. And I go, oh, good. How are you going to get there? Oh, I have a private plane. How are you going to fuel the plane if the power goes down? And who says your pilot's going to fly you and leave his family behind to take you to your gold? And then what are you going to do when you get to New Zealand? They'll be waiting for you and probably arrest you when you get off the plane. In other words, people think they're secure, but they're not really. The place to put your gold, private non-bank storage, trusted depository, good idea. But pick a place you can get to on a bicycle, and then you can get your gold.
Yeah, and you obviously have done a lot of work with the government, and I think it was in your book Currency Wars, you did some work with the CIA and those sort of things. What is their response? Do they listen to you when you're talking about this upcoming collapse? Like, do they know it's coming, and are they preparing for it? What's your take?
Mostly no. Look, do they listen to me? Yeah, I mean, I get all the meetings I want. I meet with the Treasury and the Fed, worked for the CIA and worked with the Pentagon and facilitated and helped devise the first ever financial war game. And then I was able to participate in the game playing on the Chinese team. I got home after a couple of days at the Warfare Analysis Laboratory, and my wife said, how did it go? And I said, well, I have good news and bad news. The good news is my team won. The bad news is I played for China. So, So that kind of planning goes on. People think about it. They take it seriously. They want to know more. But at the end of the day, do they actually prepare for it? No. Do they actually change anything from a policy perspective? No. And a lot of government officials don't believe it. I was in a meeting once at the Pentagon, and we were talking about just what we're talking about here. And I described various threats to the dollar, including the one from Russia and China requiring gold, which we talked about. and things and a financial crisis that had to be bailed out, not by dollar printing by the Fed, but by special drawing rights or SDRs issued by the IMF. But that would come at a cost because China would insist on certain conditions that would lead to the demise of the dollar as the global reserve currency. Kind of lay out the scenario, and this one senior Treasury official pounded the table and he said, the dollar has been the global reserve currency. It's the global reserve currency today, and it will always be the global reserve currency. And I turned to him and I said, I feel like I'm in Whitehall in 1913, listening to John Bowles say, the sterling is the global reserve currency. It is now, and it always will be. And of course, within a year, sterling had begun its massive decline at the outbreak of World War I, when it became a net, had around a net trade deficit with the United States, shipping gold to the U.S. to acquire, ammunition, clothing, war material, agricultural goods, and all that. UK won the war, but they broke sterling, and it was never the same. So these, your standing as a global reserve currency can disappear very quickly. The dollar is vulnerable to the same thing. I'm not saying it's going to happen tomorrow, but it could. And but there are things you can do to prevent it. And that's where the conversation breaks down, because, again, I get the audience, I get the meetings, people listen, they're attentive, they say thank you very much, and then they do nothing. I'm like, well, okay, look, I can take care of myself and my family, I can write books and I can advise others, but I can't make you do something you're not inclined to do.
Yeah, and it's interesting, because there's not many politicians that talk about it. I think one was Ron Paul, who really woke me up. I remember when he was holding that silver coin to Bernanke, and that was like holding silver to the vampire type moment. It was fantastic. It was legendary.
Crossed up to a vampire.
Yeah. And just seeing that, and what Ron Paul, I think he educated a lot of the youth, funnily enough, because he's an elderly gentleman, but I think the youth really started to understand how money works and how the Federal Reserve, seems pretty fraudulent the way, you could argue that it's pretty corrupt and doesn't serve many people. But with that, just final question is, with the US being the world reserve currency, as we know, the most dominant currencies in the world, they only seem to last generally about 80 to 100 years, and we're about almost 100 years with the US dollar, close or 90. What do you foresee happening with the world reserve currency of the US? Is it going to shift away, or?
Well, a couple scenarios. One is there is another financial crisis, which I do expect, and the only way to bail it out, as we mentioned, is with these special drawing rights from the IMF. But because the BRICS countries, Russia, China, India, South Africa, and Brazil, with just one other country, Venezuela, for example, it's kind of a client state, you can veto an action by the IMF with 16% of the vote. Anything more than 15% gives you veto power, because it requires 85% approval to do something significant. So if you have a 15 plus 1% blocking power, then it doesn't happen. How many countries in the world have 16% of the votes of the IMF? It's only one, it's the United States. Obviously that's by design, so the US is in a position to block IMF actions because we have 16% of the vote. But if you combine the BRICS plus one, say in Venezuela, they collectively have more than 15%. So if they act as a bloc, they can block any action or put conditions on it. So if you have to turn to the IMF to get SDRs to bail out the world, reliquify the system, the BRICS countries plus Venezuela or some other small coalition could say, no, we're not approving that, we're going to veto it, unless you all agree that the dollar will no longer be the global reserve currency. From now on, we're going to price energy in SDRs. We'll require that the 100 largest corporations in the world publish their books in SDRs. We'll create SDR bond markets, et cetera. And that would be the beginning of the end of the dollar as a global reserve currency. That's one scenario. Another scenario is the one you referred to, Philip, which is in the last 10 years, so since 2009, Russia has tripled its gold reserves from about 600 tons to almost 2,300 tons. China has more than tripled its gold reserves, also from 600 tons to around 2,000 tons. They probably have more off the books. We don't know. We don't know how much, but you can just say they tripled it and you're on safe ground. Iran has acquired well over 100 tons. Again, they're non-transparent. We don't know the exact number, but 100 tons is a good estimate. Turkey has increased gold as a percentage of its reserves up to 12% of its total reserves. Russia, by the way, is about 20%. So, and there are other countries. 2010, was the year when central banks went from net buyers from net sellers to net buyers. Now, individual central banks can be buyers or sellers at any point in time, but the central banks collectively, since the 1970s, have been net sellers of gold, and 2010 was when they became net buyers. So Russia and China are the two biggest, as I mentioned, but also Kazakhstan, Vietnam, Mexico, Philippines, and others are buying quite a bit of gold. Iran, Turkey, I mentioned. So what's emerging is what I call the new axis of gold. Now, the other thing all these countries, or most of them, have in common, they're the target of U.S. sanctions. So Russia's being sanctioned for its operations in Ukraine and Crimea. China's being sanctioned for theft of intellectual property, limits on foreign investment, unfair trade practices, etc. North Korea is obviously being sanctioned for weapons. Iran is being sanctioned for its nuclear enrichment program, etc.
Yeah, Libya is the big one for me. Is like when Gaddafi, I don't know, a lot of people know, but he was trying to introduce the African gold dinar.
Yeah.
And obviously he had to then get invaded.
He got a bullet in the eye, and there's 100 tons of gold missing.
We saw, he conquered, as Hillary said. But it does seem to follow a logic that anyone who opposes the US dollar gets militarily invaded or sanctioned or some sort of...
Right, well, we're not going to militarily invade Russia, but we don't have to. Here's the same thing with Iran. Here's the point. So if you go into a hospital, into an intensive care ward, and find a patient and turn off his oxygen, he's going to die. Well, the dollar payment system is like oxygen to an economy. When we kick you out of the dollar payment system, your economy is going to die. It's like cutting off your oxygen supply. We're doing that to Iran right now. So it's very effective. It's very powerful. We came close to regime change in 2012, and Obama backed off in exchange for Iranian agreement to come to the table to talk about their nuclear enrichment program. Then we got a bad deal. Trump tore it up. Now we're back to financial war, where we were. And we're doing this to other countries as well. The North Korean economy is getting what we call maximum pressure, and they're suffering. So it works, but the question is, how long are the countries going to sit there and take it? And the answer is not much longer. So they're preparing to fight back, and the way you do that is coming up with an alternative payment system, so you don't need dollars. Now, the Russian ruble and the Chinese yuan are not even close to being global reserve currencies. So all this talk about the gold-backed yuan and the ruble as reserve currency, it's all nonsense. They don't have the prerequisites for global reserve currency. But you could create a new currency using distributed ledger technology, so-called blockchain. And this would be a permissioned ledger. And the difference between that and Bitcoin, I'm not a big fan of Bitcoin, but Bitcoin does not require any permission to use. You could go home tonight and mine some Bitcoin or trade it with anyone you want, that's fine. This new system, really sponsored by Russia and China, would be permission, meaning you could only join it if they said so. So it's like joining a club. And if the admissions committee doesn't let you in, you're out on the sidewalk. So they create a new digital token called the Putin coin or the Xi coin or whatever you want. They have all this gold piled up. And then they just start trading among each other. And they use this new digital coin to keep score. So now suddenly Iran ships oil to China, Russia sells weapons, North Korea sells weapons to Iran, China sells infrastructure to Russia, Russia sells natural gas to China, everyone takes a vacation in Turkey because it's a nice place. You've got all this trade going on, throw in Brazil, where China could prevail on Hong Kong and make Hong Kong part of it, et cetera. And you use these tokens just to keep score. And then periodically, once a year, twice a year, whatever, you settle up. So you've sold me a bunch of stuff. I've sold you a bunch of stuff. There's a net balance. Let's say I owe you money on balance. I pay you in gold, physical gold. And the gold itself, the weight is pegged to some store value other than the dollar. So it could be SDRs, or it could be another basket of commodities, anything else you like, oil, et cetera. So, and the point is, and then you have but you create an internet that you control, not the World Wide Web, to send all this message traffic. So now, what's missing from that system I just described? The dollar. There's no dollars in it at all. Goods are moving around, scores are being kept, payments are being settled in gold, but no dollars involved. And this is the key thing. If you do it on a net basis, you need a lot less gold. So if every time somebody ships something, you have to pay gross in gold, it's not enough gold to support that. But if we ship all day long and keep scoring tokens and settle the net, you need a lot less gold to settle that net payment. And the gold could be flown around on planes, but you can put it in a depository and just change the name tags. That system is coming. It's already underway. The gold's being acquired. That's the foundational step. The technology is out there. I mean, it's not that difficult to do, and they're taking steps in that direction. So this could come very quickly and very unexpectedly, and is also another challenge to the dollar. So, and then the third way, I think, is the Fed just blows it. The Fed just, in response to a crisis, says, well, we can print $5 trillion, and they find out the hard way they can't.
Yeah, no, it'll be interesting to see how it plays out. And we'll just finish on a final positive note. A few years ago, I was looking to start a political party because I was like, well, try to introduce new ideas, and I realised you got to play too much in their system to try to do that. And recently, there was a country near where I'm from, Croatia, where a guy started his own country basically, and all you need, I think, was like 2 other countries to recognise you on a passport and a few other little things. So this is an idea I've been toying with in the background, and I was thinking, well, if I created like a dream team of people to kind of piece it together, who would I pick? And now if I selected you, Jim, and I put you at the head of this new country, what are the key things that you'd probably try bring in to make it, whether it's the economy run or people to live? It's a bit of an oddball question, but I'm interested to see what you think would be the way to run it.
I'm a pretty loyal American, so I'd probably stick with my own country. But just as an abstract exercise in political science, I guess the first issue is what physical territory do you have that no one else has a prior claim to? How do you get your land? You can go find some small island someplace.
Well, Greenland's for sale, isn't it, or something like this?
Well, no, that would be a good deal. I favor buying Greenland. The thing I like about that is the United States is, the mainland of the United States and Alaska. And if we got Greenland, we would have Canada surrounded, so they couldn't mess with us. But the seriously, Greenland proposal is serious. It would give the United States a larger claim in the Arctic, which is where a lot of activity is going on, and then probably a lot of natural resources, buried under all that ice. Once it melts, you can get easier access to it. Fishing, there's a lot of attractions to Greenland. And I think the Danish Prime Minister kind of shot from the hip when she, denounced Trump. She might have given that. See, if I were the Danish Prime Minister, I would have said, $100 billion takes it away, your move, and then put the ball back in Trump's court. He likes to do deals. Anyway, I'll leave that to the Danes. But assuming you could find some place that no one else had a claim to, you need something. You need your 2 allies to recognize you. You probably find a couple of countries here or there. You need something to drive your economy. Do you have any population? How are you going to get people to move there? Historically, financial services have been a good way to get an economy moving. But the problem then is, unless you have your own currency and your own network, you sooner or later, you have to plug into the dollar payment system. So you're back to the problem I described earlier, which is the United States controls the dollar payment system. So, perhaps some kind of cryptocurrency that couldn't be easily controlled by another government. And then how do you create confidence in it? Do you want to back it with gold? Where do you get the gold? Maybe you can get a loan somewhere. These are the issues. Do you want to drive it on tourism? You need an economic model, I guess, is the first thing I would say.
Okay, awesome. Well, I'll be in touch after in the aftermath, and once I've got my country settled, we'll get some advice.
Maybe I'll join your central bank. So.
Fantastic. Well, thanks, Jim. And for people watching, I'll put a link below to your book. What's the best place they can get Aftermath?
Amazon, Barnes & Noble, or good local bookstores.
If they still exist, I don't know. But you get it online. It's also in Audible form, so if you're like me and you don't have much time to sit there and read, you can listen to it on the train or when you're exercising, things like that. So thank you very much, Jim. Appreciate your time. And hopefully the next book, in the wake of the aftermath, is going to be a positive front title and a picture.
We'll keep writing.
Awesome. Thanks, Jim.
Thank you. Thanks, Phil.